We walked through diversification and how it can benefit you as an investor, but how do we bring this into practice? Time to introduce you to a few more investment terms: asset class and asset allocation. First, what's an asset class? There are lots of different types of investments, and many are similar to one another. In fact, some investments are so similar they can be grouped together. Investments that share common features, risks, and even returns can be grouped together in what we call asset classes, and there are three common ones we'll go over here. Equities. These are typically stocks. Historically, equities have been the riskiest asset class. They've experienced the biggest swings in value, but they've also performed the best with higher rates of return than other asset classes. Fixed income. A popular example is bonds. Fixed income products are where you provide a loan for a set period, expecting that you'll receive your money back at the end of the term. You'll also receive interest payments for your loan. These investments are generally considered less risky because historically their value hasn't fluctuated as much as equities. The trade-off, though, is that returns have been generally lower than equities too. Then there's cash or near cash equivalents, which are sometimes referred to as money market investments. This includes U.S. Treasury bills and guaranteed investment certificates, or GICs. They're usually thought of as the safest of all investments, but historically, this also means the returns have been the lowest out of all the asset classes. When you diversify, you're building your portfolio so that it includes a mix of different asset classes. This is called asset allocation or asset mix. How you split your investments across different asset classes is up to you, and this decision can be based on your investor profile. Everyone has one, and it can usually be determined by a couple of key factors, like how much financial risk you're willing and able to take on, and when you'll need to access your money. There are three preset profiles to choose from in TD Easy Trade: conservative, moderate, and aggressive. Once you make your selection, you'll see a suggested asset allocation mix. For example, if you select a conservative profile, you'll see an asset mix that's mostly cash and fixed income products rather than equities. That's because the main goal of a conservative investor is to preserve money rather than take risks. On the other hand, an aggressive profile might show equities taking a bigger piece of the pie. That's because an aggressive investor is looking to maximize potential returns, and they're willing to take risks to do it. If you don't feel as though any of the profiles suit your style, no problem. You can also choose to create your own. That's a snapshot of how TD Easy Trade can help you select your desired asset mix. The next step is to decide which securities to invest in. Using TD Easy Trade, you can invest in stocks, ETFs, and one-click ETF portfolios. We'll run through each one in another video.